You check your portfolio. The European fund you bought 18 months ago, the one your advisor called safe diversification, is quietly hemorrhaging money. Most advisors won't tell you this, but your money is silently moving out of Europe. It's down 11%. Not a crash, just a slow, consistent leak. You tell yourself it's temporary, market noise. But when you scroll past the holdings, 3 of the top 10 companies are German industrials, and they're all bleeding the same way. Here's what nobody told you when you bought in. Germany isn't having a rough quarter, it's having a structural collapse. The factories that powered Europe's economic core for 70 years are shutting down, not because of a recession, but because the model they were built on no longer exists. And the money you allocated to safe European exposure is funding the unwinding of that model in real time. This isn't about Germany, it's about what happens when the industrial anchor of an entire continent breaks free. And who pays for it while the system pretends it's still holding. Stay with me for the next few minutes and you'll understand exactly how this happened, why it's accelerating, and what it means for any capital you've placed inside this system, whether you realized it or not. Let's start with a person. Jürgen is 52. He's worked at a chemical plant in the Ruhr Valley for 28 years. Good benefits, stable pension contributions, the kind of job that used to mean security. 3 months ago, the plant announced it was moving production to Texas. Not all of it, just enough to make his building redundant. The severance is fair, the pension vests, but the next job that matches his salary doesn't exist within 200 kilometers. Now zoom out. The plant didn't move because Jürgen or his coworkers did anything wrong. It moved because the cost structure underneath it shifted permanently. German factories don't just need workers, they need energy. Lots of it. And for 2 decades, Germany ran the most energy-intensive industries in Europe on a single assumption. Cheap Russian gas would always flow. It doesn't anymore. When the Nord Stream pipelines were severed in 2022, Germany lost access to natural gas that cost roughly 1/3 of what it now pays on the global market. Industrial electricity prices in Germany are now triple what they are in the United States. For a chemical plant, an aluminum smelter, or a steel mill, energy isn't an operating cost. It's the operating cost. And when that cost triples, the factory doesn't limp along, it closes. But here's what makes this different from a typical business cycle downturn. These factories are not coming back. The infrastructure that made Germany the industrial center of Europe was built for an energy model that no longer exists. Replacing it would require capital investment on a scale Germany hasn't attempted since reunification. And that capital isn't coming because the returns don't justify it anymore. So what happens instead? The companies don't disappear, they move to America, to Asia, to anywhere energy is cheaper and regulation is lighter, and the workers, the suppliers, the towns built around those factories, they stay behind and adjust. Jürgen is adjusting. So are 2 million other Germans employed in energy-intensive manufacturing. And the pension funds and equity indexes that hold shares in those companies, they're adjusting too. Slowly, quietly, in the form of returns that don't match the promises made when you allocated the capital. This system-wide shift is silently hitting every investor holding European exposure. Here's the part most analysts won't tell you. When a German manufacturer closes a domestic plant and opens a new one in South Carolina, the company survives, the brand survives. The stock might even stabilize. But the economic value that factory used to generate inside Germany, the wages, the taxes, the downstream supplier revenue, that value doesn't move with the logo, it transfers. So who actually pays when Germany's factories move abroad? You do. Let's make this concrete. If you own a global equity fund or an ETF with European exposure, you probably own shares in BASF, Volkswagen, Siemens, or ThyssenKrupp. These are some of the largest industrial companies in Europe. And over the past 18 months, every one of them has announced factory closures, production cuts, or relocations. Not because of poor management, because the underlying cost base in Germany makes domestic production uncompetitive. But here's the trick. When analysts model these companies, they often treat this as restructuring, a short-term cost to unlock long-term efficiency. And maybe that's true for the company, but it's not true for you, because the equity value you're holding is tied to an economy that's losing its production capacity in real time. Think of it this way. You didn't buy shares in a German company. You bought shares in the German industrial model. And that model was never just about good engineering. It was about subsidized energy, EU regulatory protection, and export dominance into China. All 3 of those conditions have reversed. Energy is expensive. China is producing its own advanced manufacturing. And the EU is fragmented on how to respond. So the capital that flowed into Germany for decades, from pension funds, from sovereign wealth funds, from retail investors chasing stability, is now funding the unwinding. You're paying for the severance packages. You're paying for the factory decommissioning costs. You're paying for the pivot to cheaper markets. And the returns you were promised? They assumed the old structure would hold. Here's where most people get it wrong. They assume governments will step in, that Berlin will subsidize energy, or the EU will provide industrial support, or some policy will stabilize the situation before it gets worse. And maybe they will. But here's the constraint no one talks about. Germany can't afford to. Germany's federal budget is constitutionally limited by something called the debt brake, a rule that caps annual borrowing at just 0.35% of GDP. It was designed to enforce fiscal discipline, and for years it worked. But it also means Germany has almost no capacity to respond to a structural economic crisis with the kind of spending that would actually matter. Meanwhile, the political coalition governing Germany is fracturing. The Green Party wants to accelerate the renewable energy transition, which is necessary long-term, but doesn't solve the immediate problem of expensive electricity. The business wing wants deregulation and tax cuts to keep factories competitive. And the center-left wants to protect workers and pensions. All three goals require money Germany doesn't have, and borrowing it can't legally do. So what actually happens? Nothing decisive. The factories close one by one. Workers retrain or retire early. Municipalities lose tax revenue. The structural adjustment happens slowly enough that no single moment feels like a crisis, but added up over 3 years, and the compounding loss is enormous. Here's the number that matters. Germany's industrial production is down 12% from its 2018 peak. That's not a recession dip. That's a permanent baseline shift. And it's happening inside the largest economy in Europe, the economy that anchors the euro, backstops EU debt, and funds the fiscal transfers that hold the union together. If Germany's industrial core keeps shrinking, the entire European financial system has to reprice what stability means. And who absorbs that repricing? Every investor holding exposure to that system. This is the point of no return. The factories that are closing now aren't going to reopen. The energy model that powered them is gone, and the political capital required to build a new one does not exist, not at the speed the market is moving. What this means is that the Europe you invested in, the one where Germany was the industrial anchor and the euro was backed by export strength, that Europe is becoming something different. Not collapsed, not chaotic, just structurally weaker. And structurally weaker economies generate lower returns. So if you're holding European equity exposure because an advisor told you it was diversification, you need to ask yourself a very specific question. Are you diversified into growth, or are you diversified into adjustment? Because adjustment is what's happening. An adjustment doesn't pay dividends the way growth does. Let's go back to you. You're not a policy analyst. You're not a European industrial strategist. You're someone with money in the market trying to make intelligent decisions about where that money works hardest. And the reality is this: capital is mobile. Factories aren't. Right now, there's a quiet but massive reallocation happening. Institutional investors are reducing European industrial exposure and rotating into U.S. manufacturing, Indian infrastructure, and sectors that aren't anchored to legacy energy costs. They're not selling in a panic. They're just trimming, rebalancing, protecting downside. And when that happens at scale, it creates a feedback loop. German companies lose market valuation. That reduces their access to cheap capital, which makes it harder to invest in the renewables or automation that might make them competitive again, which accelerates the move offshore, which reduces valuation further. You don't have to predict the future to see where this goes. You just have to acknowledge what's already moving. Here's the trade-off no one mentions. Holding European exposure right now might give you geographic diversification on paper, but it's also exposing you to a multi-year industrial contraction that most models haven't fully priced in yet. That doesn't mean sell everything. It means understand what you're holding and why. Because if you're holding it for safety, you need to ask, safe relative to what? Let me show you two versions of the next 5 years. In the first version, Germany muddles through, renewable energy scales up, electricity prices stabilize, and some factories survive by automating. The economy doesn't grow much, but it doesn't collapse either. Europe becomes a lower growth, higher regulation bloc. And if you're holding European equities, your returns are flat to slightly negative, but not catastrophic. In the second version, the industrial decline accelerates. More factories close. Unemployment rises. Political pressure mounts to abandon the debt brake, but that fractures the EU consensus on fiscal rules. The euro weakens. And the safe diversification you thought you had turns into a prolonged drag on your portfolio performance. Neither of these is a conspiracy. They're just the two realistic paths forward when a major economy loses its structural competitive advantage. And here's the thing. You don't get to choose which path happens, but you do get to choose how you're positioned for each. You check your portfolio again. That European fund is still down 11%. But now you understand what you're looking at. Not a temporary dip, a repricing. The market slowly recognizing that the industrial base those companies were built on is moving, and the capital that stays behind earns the return of a system in adjustment, not in growth. The question isn't whether Germany is collapsing, it's whether you're still allocating money as if it isn't. If this breakdown helped you see the system more clearly, subscribe. This channel is built for people who want to understand the forces moving their money before the Wall Street headlines catch up, so you can position yourself ahead of the shift, not after it.